what we're trying to figure out is how worried are you about the current situation, and how much exposure do you want to have to gold versus equity versus real estate and other asset classes? Talk to us about that.
So I think I'm going to answer it in the following way, that I think that is the right way for people to look at it. It's the way I look at it. I think that the first thing is you should have a strategic asset allocation mix that assumes that you don't know what the future is going to hold. And I think most people should, because, in other words, when let's say, I play the game of betting against others. So it's like going on the poker table, and if I'm smarter than the other, and I know how difficult that game is. So very few winners, and you know, like if I'm not engrossed in it, and we're not engrossed in it, I'd be worrying about it, and I do worry about it when I am engrossed in it. So the average investor and most people should not be playing that game. They're going to lose at the poker table. And so what that means is they should have a properly balanced portfolio. Now, the most important thing about that is that they make a mistake of balancing it in terms of dollars invested, and with a bias to what's done well in the past. And they don't realize that risk, they should balance it in terms of risk. Let's say stocks have twice the volatility of bonds, more than twice the volatility of bonds. So when they own a portfolio and structure a portfolio that way, they tend to have concentrated risks. And I think that what they need to do is, I would recommend, read how to, on the subject of risk parity, read on our website, we have an explanation of how to balance risk. But the key thing is that there are basically 4 economic environments. There are 2 main drivers of asset class returns: inflation and growth. Assets all price based on you could look at the pricing of assets and calculate what the discounted growth rate is and what the discounted inflation rate is. And what causes assets to move is surprises to that. So when growth is faster than expected, stocks go up. When growth is slower than expected, stocks go down. When inflation is higher than expected, bonds go down. When inflation is lower than expected, bonds go up. Okay, so
but
if
growth
you can,
has not been faster than expected today, and equities have gone up.
What I'm trying to say is that for the average investor, what I would encourage them to do is to understand there's inflation and growth. It can go higher and lower, and to have 4 different portfolios essentially that make up your total portfolio that gets you balanced. Because in every generation, there is some period of time that will there is a ruinous asset class and will destroy wealth. And you don't know which one that's going to be in your lifetime. So the best thing you can do is to have a portfolio that is immune, that is well diversified, that is what we call an all-weather portfolio. That means that you don't have a concentration in that asset class that's going to annihilate you, and you don't know which one it is.
What should that portfolio look like today?
No, well, I'm saying it should be based on the notion that you don't know which one it is, and therefore, when you say which should it be today, it should be balanced today like it is in the future, and it should have that mix of assets. And then how you get into it is a whole conversation. I would say, you know, on our website you can read about what we call a weather portfolio or risk parity, but you need to achieve balance. That's why when you ask me something about gold, a certain limited amount, at least passively, should be in gold, just like you would hold a certain amount in cash, but you don't want to hold too much in cash because it'll have a return. You want to hold a certain amount in equities, and then you want to hold a certain amount in bonds, in long duration bonds, so that it'll have an offsetting effect on the equities, so that you're having a diversified portfolio that balances. And if I fear that if I go deeper into the question, we will be going on quite a while.